while some online bullion dealers continue to charge almost $2 over spot for 1 ounce silver rounds, SD Bullion is selling 1 ounce silver rounds at only 49 cents over spot on any quantity. Again, that's $9.99 fine silver for just 49 cents over spot for any quantity. If you haven't joined the over 40,000 precious metals investors by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend Harvey Organ. Harvey, it's great to have you back on the show.
Oh, it's great to be with you guys today. Thanks for having me.
Well, it's a great time to have you on here as gold and silver prices finally burst out of their week-long slump here yesterday as Janet Yellen and the Fed disappointed in the face of hiking rates by really backing down from all the rhetoric over the past 2 weeks that they're going to be hiking aggressively the rest of the year. The dollar's down very hard, looks to be in the near future potentially taking out 100, which sets up a really big move in the dollar. And both gold and silver have moving really up above crucial averages. Gold is back above 1,200, traded above 1,230 overnight here. It's back above its 100-day moving average. Silver from pre-Fed was trading just around 1685 at the low, shot back through 17 all the way to about 1755. It's worked off a little bit of that here as we record after the U.S. close here on Thursday. But it's really been a great 24 hours for the metals. So let's start with the trading action and all the action with the Fed, Harvey, and your take on the Fed hiking rates for the third time in, about 15 months here.
Well, I think that this is probably going to be the last hike. You're going to see right after this, the debt ceiling is actually today. It's going to be announced, I guess, at $20.1 trillion will be the official. And they're going to reach that in a few days. And then you've got about $500 billion of trust funds, federal funds like for the the wealthy veterans and all these different accounts that they have. So probably by Memorial Day, they'll run out of money. That's when the fun begins because there's two sets of Republicans, the Tea Party guys who are not going to vote for an increase in the debt ceiling. And then you have the neocon guys like Lindsey Graham and John McCain, and they'll be fighting like crazy. And the Democrats are certainly hateful of the Republicans. There's going to be no deal. And they're just going to be sitting there and nothing is going to be accomplished. Nothing. And all of a sudden, we're going to reach this debt ceiling, and the United States is going to say, wait a minute, we can't raise rates in this, and the whole thing is just going to come down like a ton of bricks. So that's going to be by Memorial Day. So this debt ceiling is a big deal now, okay? As opposed to, it was trouble years ago, too. And certainly there was trouble in 2011. 2013, Obama basically said, okay, let's suspend this for 2 years. And that suspension is due finished today. So there'll be now an official new debt ceiling today, and the countdown begins. So so I wouldn't think that there's going to be another rate hike. I think the economy in the U.S. is not doing well at all. The GDP by the Atlanta Fed just said only 0.9%. For the first quarter estimate, and that's using a deflator, which is way off because the U.S. inflation is rising. They're using a fictitious deflator, so the real growth in the United States is zero. So it's going to be very, very hard for the United States to grow. The other thing is their wage growth is zero too. They're not, and that's the one factor that Yellen wants. She wants to see that wages are rising so they can buy goods and buy things. And that's going the other way. So
actually, the recent numbers have been showing a slight uptick. I mean, there's a very small amount of official inflation with official government numbers that are coming through. So the wage rates have been up 2% growth. in recent months. And that's part of the reason why the Fed is, kind of nervous about forward inflation expectations and people beginning to talk about things like, the infrastructure spend is going to relaunch commodity super cycle nonsense and all that stuff. So part of why they moved yesterday was that they're just simply being forced to move. The Fed does not set policy. The markets move the Fed around by the nose. It's the way it's always been.
Well, what's your guys' thoughts here? I mean, most of our listeners are very well aware of how gold and silver have responded to the last two rate hikes. Last year, a year ago, gold and silver, they rallied for almost 8 months nonstop from mid-December until early to mid-July before topping. And then this year, it was about 3 months from mid-December till mid to late February. I guess about 2 months. So what's your guys' take here? Are we going to see a renewed bull move here, taking out the highs of last summer of 1380 in gold and maybe even 21 in silver on the back of this rate hike over the next, say, 3 to 5 months?
Okay, I'll answer that. Generally, you're seeing whenever they do hike the rates, gold rises. And the reason is because of the perception that they're inflating. And gold is a very, very good hedge against inflation. But another thing you guys should note is that gold rises every time a debt ceiling crisis comes, or when they start putting a new debt ceiling. You go back and you see gold rises. So somehow you got that factor. So you got two of those things coming together yesterday, and that was probably one of the reasons why the traders said they don't want it to be short gold, and they started buying gold immediately and started covering some of their shorts at the COMEX. Anyway, that's my take as to what's happened.
What's your thoughts, Eric?
Well, yeah, I mean, we're going to definitely, my forecast is the same, and it hasn't changed at all for months, and that's that we're going to see much, much higher prices this year. We are going to possibly see the Fed forced to do one more rate hike just because the markets are going to force them to do that. But that's neither here nor there. They will, in fact, tuck their tail between their legs later this year in recognition of the economy rolling over, in recognition of the political turmoil being created in the United States as being off the fricking charts, where the warfare that's going to go on, that went on, 2013, 2011 with previous budget fights and debt ceiling raises and the S&P downgraded the United States credit rating from AAA to AA back in 2011. All of that kind of stuff that was going on that we've seen, and how that has been a support to gold periodically when the powers that be aren't beating the snot out of gold and trying to counterbalance the psychological warfare, trench warfare that they do. We're going to see a lot higher prices. I mean, the fundamental tick-off that we could do for the reasons why precious metals should be going higher this year are legioned. There is an enormous confluence of factors that will lead us to much, much higher gold prices. Harvey mentioned the Memorial Day period as being kind of like a point on the calendar where we can expect a political fracas going on in Congress vis-a-vis the debt ceiling, combined with the trust funds and other pockets of money that the executive branch can tap into to pay the bills of the country going dry is going to extend to then. But the actual political fight, just like what we saw in previous years, will extend for maybe 6 to 9 months. So, I mean, last time around we had national parks being shut down and all kinds of stuff that were like political theater to try to have the partisan warfare ranks line up on each side as they were, shooting salvos at each other. And that kind of thing is going to be all the more intense. I mean, when we compare the political climate of the Obama administration and when those national parks were being closed and all that was going on then, with the tenor of what's going on now, with literally major factions within the United States oligarchy lining up and just shooting at each other when it comes to the fight over the Trump administration and its legitimacy and the kind of propaganda war that's going on in mainstream media that's even global. I mean, it's insane.
It's a good idea, Eric. This time, can we shut down Planned Parenthood and the CDC, the FDA, and the EPA?
Just put a clothesline over Washington, D.C. and Toto. I mean, geez, I don't know. I mean, what we're shaping up for is going to be like a political/geopolitical backdrop to all of the other things that impact the price of gold and silver. That's just, it's going to blow people's minds, I think. So it's going to be an all summer long kind of thing. I think David Stockman's writing the very best analysis on all of this, and his work's been just spot on.
Can I ask you a question? Do you think, let's say it's now Memorial Day, and all of a sudden and they can't agree with, obviously it's going to happen. Do you think that Yellen can raise rates on this? She wouldn't even
No, I'm not talking about the Fed raising rates in the month of May. I'm talking about the Fed having their backs against the wall during the course of this year, where because of what's going on in the credit markets and the inefficiencies that have been created by the nonsense policy that we've been running, where you try to save a system that blew up by blowing up new bubbles, creating dollar shortages all over the world, credit market distortions of the yin-yang problems when vis-a-vis how the U.S. dollar zone interacts with the China renminbi zone, on and on and on. All these unintended consequences of aggressive manipulation of markets so as to fix problems engendered by previous manipulations of markets have grown to create an unstable edifice. And so there are times when the Fed actually has its back against the wall and they're forced to raise. And that's what happened this time around. They didn't want to raise.
Yeah, but they did. Okay. And of course, it presented with Kathleen Hayes, who point blank asked Yellen the question, and what changed? And Yellen was shocked at the question. She was expecting the softball lobs, and she didn't know how to answer it. So it is a problem. The other issue that is going to come is the increasing physical demand for gold that's coming from London and China. We're seeing the ABX platform, being introduced in London, and that is a physical platform, and that is taking a lot of the unallocated gold into physical gold, and that's putting pressure on the boys over here. They can't find the physical gold that they need to cover their obligations. And that's the other issue of which they cannot control, that the comics boys and the bankers have a lot of problems trying to locate physical supplies. So that's the other issue that will probably enter into the next 6 months.
Yeah, and, we've seen backwardation on the LBMA periodically this year, so, it's there. They try to hide this stuff. They did away with the GOFO rate reporting and all of that, but the market is tight, even though the mainstream media is trying to continue to paint the picture that it's not. With stories going back all the way to last winter, December, with China being reported as having a big drawdown in physical demand, when quite the contrary, it was just the government selling a little bit, whereas the overall entire country was scarfing down 158 metric tons through Swiss refiners.
Well, they're going 24/7 in Switzerland still are. Gold is backward about $3 in London now, so it's still there. The demand is very, very strong in London, and you can see that in the figures, in the export figures. London is certainly exporting a tremendous amount of gold into Switzerland, and Switzerland is then shipping a huge amount into the Shanghai Gold Exchange, the SGI. Okay, so you're seeing the movement of physical gold, and that is very good. When I start seeing that, I'm happy. And then I'm hearing from Andrew McGuire is telling me that the demand is going through the roof over there, and he's part of the new ABX system, which is good. So we're certainly they're taking a lot of those paper obligations and turning them to real physical, and therefore it's presenting a problem to the banks with all these paper obligations floating around being turned into physical, and then all this, it's a mess for them. And that's why I'm also seeing very little gold entering into the comic. Very little gold. And it's amazing. For the whole month, I'm seeing nothing coming in. And so this is a good sign that gold will certainly rise dramatically, and will take with it the massive manipulated silver along with the ride. Okay.
Yeah, it's interesting, Harvey. I mean, I think most people for years have thought that silver would be the one that would ultimately break the market. There's really just not as much of it around. Central banks don't have it. They don't have reserves of silver anymore. It's all gone. It's really just-in-time industry from the mines and recycling coming back into the market. So do you think that it's actually going to be gold that does the banks in and not silver? Is, say, JPMorgan, are they more concerned about gold than silver right now?
That's a fascinating question. As you know, JPMorgan has been accumulating massive amounts of silver. In their vaults, they've got about 550 million ounces. It's debatable. We don't really know if it's theirs or if they're holding it in trust for a sovereign or whatever, but they certainly have that. This month, they've been stopping means receiving. They've been stopping about 90% of all the silver contracts. So when they want silver, obviously there's fire. There's smoke and fire. And that's certainly the silver problem, okay? Now remember, silver, there's no above ground silver left. So they have to, in order to contain the price, you need to have derivatives. Where gold certainly has above ground levels, official levels, of which the central banks use in order to suppress the price. So now your question now is to me is will gold lead silver? I still think silver is a mess. And right this minute, the attack by the bankers is not necessarily on the open interest, the high open interest on gold. It's because the managed money of what we call these hedge funds are refusing to play anymore. So they have not budged for the first time. They're not playing the game. They're saying, so when you whack silver, they don't release their contract. They're still holding it. This is the first time they've done this in 8-10 years. So are they realizing this game is coming to an end? Do they look over their shoulder and see what JPMorgan is doing and say, wait a minute, JPMorgan is buying, I better do too. So the hedge funds say, I'm going along with JP. You know, let's take some physical silver. So anyway, that's what's going on. They may both blow up at the same time. Okay, but there's two major stories going on right now. You're certainly having the manipulation on the silver and the desperation of the bankers to try to contain the price of silver. And the other issue is the huge demand for gold, which is the real physical wealth for the world. And countries are after it. You can see central banks purchasing of gold, certainly the Eastern nations. There's all the stands, and you have Russia and China, certainly, and of course India, bringing as much gold as they can onto their shores. And certainly that's having a major influence on the world. Is there anything else you guys want to talk about that?
You got any thoughts, Eric?
Yeah, I mean, silver and gold will be in a kind of a waltz together, and the powers that be are concerned about both because both metals trigger each other. One time silver might be gaining more passions or be in more restrictive supply versus gold and what have you. I mean, we get those kind of things. But reality is that gold is such a larger market. There are the central bankers that are going around and scooping it up in Asia, et cetera. And when monetary crises hit, when major shocks to sentiment come about, more often than not, gold will respond quicker and sooner, particularly with the monetary concerns and whatnot. So it could very easily be that in any given end game scenario or like prequel to an end game scenario that gold would initially be more of a catalyst than silver, but they're both going to be catalysts and they're both problems. Right now we see silver not too far away from its all-time open interest high on the COMEX when it's flopping around under $20 versus where it was almost $50, and then similar levels of open interest. And that speaks to the sheer volume efforts of contractor origination and flooding of the markets to sop up the ongoing rising demand. I mean, some of these hedge funds that are going long don't even necessarily have to care nor understand all that much about what's going on when it comes to the manipulation and whatnot, because they're so flushed with cash, and we have, financial markets that are just so ginormous that some of these monkeys flinging around to just go long on inflation expectations and no other deeper thinking is part of JPMorgan's problem too. It's part of why the Fed is feeling like it's got its back against the wall, needing to raise rates because of this rising tide of inflation expectations that they're deathly afraid of coming around and biting them in the butt later this year. And it will. So,
And then the problem, Eric, is once those monkeys do that because of inflation expectations, you've got all the momentum monkeys.
Yeah, monkeys everywhere. Monkeys.
Oh, I see gold and silver. They're moving. They're going up. Time to jump on board.
That's the way they trade in the West. They love seeing the momentum and chasing it, whereas the Asians, generally speaking, are more prudent and they sit and wait, by their time, buy the dips, unless if it's a holiday or if the wife needs, a dowry, or the daughter, I should say.
So anyway, that's very true. The other thing that you guys should kind of watch for is the class action lawsuits and the emails that these bankers they've supplied somewhere around 360,000 pages and 75 tapes, and it's very harmful. And we've got a delay because our government, or actually the U.S. government, wants to come in our tape as well, and so they want a delay so they can get up to snuff with what the class action lawyers. So that's why there's a delay in this case. It's amazing. So they actually had 10 years, and my testimony in Washington and everything else, and we have been constantly giving them data, and all of a sudden they need a year's time. But those emails are really something. I don't know if you guys had a chance to actually look at them, but they're quite bad. They're collusive. They're breach of trust. It's severe.
Yeah, it'll certainly be fascinating to watch as that all plays out. I mean, I think most investors in the space are a bit jaded to all the talk about it because it's been so long and nothing's happened on the litigation front.
That's why. A lot of people don't know. And see, the lawyers haven't really explained to anybody. All of a sudden, there's a lull for 3 months. And why? It's because the feds, they came in and they went to the judge and said, listen, we need a year to come, and we want to join this. We'll probably either join or we'll be on our own, whatever it is, but please delay the case while we come up to snuff. And the judge is put this in, is now reviewing whether she's going to allow it or not. And that's been 2 months now. Amazing what goes on. And what Deutsche Bank has got real problems, and because they went unilaterally on themselves. They had to because they were in a mess, and they had to give up all those emails. And boy, did they damage Scotia and HSBC and UBS. Boy, were they! We don't have JPMorgan yet, but I think there's another case going on with JPMorgan. But as far as the two key, we got HSBC, UBS, and Scotia, and we're certainly going to get emails from them. There's just no way that we're not going to get them, and then that's going to lead to others, and we're going to get, and this is both gold and silver. It's just not the silver fix; it's everything. So that's coming on. So we have a delay, but rest assured, there's going to be more.
All right. Well, appreciate the update, Harvey. And I'm sure your regular listeners are very familiar with your work. Post your nightly updates on Silver Doctor. So keep up the great work. Appreciate all you do and keeping everybody up to date.
My pleasure. Thank you so much.
All right. For the doc, Eric Dubin and Harvey Organ, thanks for tuning into this week's SD Weekly Metals and Markets.